The S&P bounced almost perfectly off of the daily 20 SMA and the higher low zone that we've mapped out over the last week or so. But should we trust it considering that this week we get the big labor report? Well, the recent trend is that markets gap up big time and then fade hard on weaker than expected labor data. However, looking at all of these with the benefit of hindsight, they lead to great higher low opportunities. The problem is, we just set an organic higher low and taking it out would actually break the trend. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we're left with an indecisive doji, which really doesn't tell us much about who has the edge here, bulls or bears. We've closed almost unchanged from the weekly open. However, if we pair it with location, we start to learn a little bit more. We've produced an equal low as well as a higher high on the bar-to-bar count, but the most important part is that we've closed back inside of an unchanged from the previous week's range. So overall, with the indecision from candle structure and the lack of acceleration into new highs, I would start to make the assumption that the weekly trend is slowing down here, or at least consolidating, which I think is a fair assumption, right? We tested into new highs and then really closed unchanged, so that momentum isn't really continuing. Now, this is not a call for a market top. Obviously, the weekly trend remains in the upward direction. This is still the highest high in the trend count, but I think we want to be extra cautious of the 2 equal lows that have now been set. And as we know, because this is the highest high in the trend count, if a pullback were to emerge, if we take out the 2-week equal low, we're probably still thinking about this spot around 638, previous resistance, which acted as support already once on a weekly gap down, to act as a possible firm weekly higher low and preserve the trend. We also still know that the weekly chart could still pull all the way back into the previous all-time high, set a daily downtrend to get there, and don't get me wrong, there will be plenty of short opportunity to navigate to that level, but is it still going to qualify as a weekly higher low? In my view, the answer is absolutely yes. So once again, not a call that a top needs to be in right here, right now, but I would certainly pay attention to the 2-week equal low that was set as of Friday's close, and that level is around 654.25. We'll see it with more detail on the daily chart in a second. But let's come in here with some supporting evidence. Let's firstly start with our Fibonacci from this low up to the new all-time high, and just point out that even if we pull back to the first major reference point, it's still over the Fib 38.2, and if we were to pull back to the Fib 61.8, notice how that is perfect confluence now with the previous all-time high. So I would say that this still supports the bullish thesis on the higher time frame weekly. If we come in from the major low, just to check in because we did produce that new higher high, let's see if that 38.2 is slowly creeping up. It will over time, but it's currently not confluence with the prior all-time high. By the way, this level is 613, and this level, just to say it one more time, is about 638. All right, so let's clear that up. Let's come in here with our anchored view apps on the weekly time scale, and you'll notice that we're above the entirety of the stack. If we bring out this level right here, it is perfect confluence with this breakout anchored view app here. It would be an overshoot of this pullback anchored view app, but not the end of the world. If you think about this from a data perspective, just counting anchored view apps literally, you have 5 on the screen here. This would be a violation of 1 and a hold of the secondary anchored view app. You're still batting 4 for 5. That's a pretty good look here on the weekly time span. If we bring in the volume profile, what we'll find here, because we're trading near all-time highs, is not much above. However, I just want to reinforce the 2-week equal low by doing something that looks like this. That is the high volume node. If we break down underneath it, it wouldn't be unreasonable to move to the next high volume node. That would be right around in here. This is lower volume there. And lo and behold, what is that? That is the 638 level that we were just talking about, still able to preserve a weekly uptrend via a higher low. So once again, the top watch here is really just the 2-week equal low. Let's see this on the daily chart now. Let's begin by evaluating this week's expected move, the trend, structure, the whole 9 yards. So if you're not familiar with the expected move, it's this gray box right here. You can check out the video tutorial in the top right-hand corner on how to set that up. If we're contained by the upper bound, the number is going to be at 670.44, implying a brand new all-time higher high, or a brand new all-time high and a higher high inherently in the trend count. If we're contained by the lower bound, the number is going to be at 653.20, and that's mostly on par with the 2-week equal low that we were just talking about. Here's the FOMC low, and here is the low from the pullback on Thursday of this last week. So that's going to be your critical line in the sand, because if we're thinking about the daily trend, we know that this was the last major low in the daily trend count. We did not flip to an hourly downtrend here. We did not flip to an hourly downtrend here. We just saw volatility after an equal high. So this was a soft higher low, but we have fallen into an hourly downtrend from the all-time high here over really the Tuesday, Wednesday, and then Thursday session. So because of that, this is a firm higher low in the daily trend count, and therefore taking it out to the downside, should the market do something that looks like this, we would actually yield a lower low, and thus we would start the weekly potential for a pullback via a daily downtrend. And as we know, what's the key watch there? Of course, just zooming back out slightly, it is this area right in here, around 638. That's that prior shelf of resistance, which had acted as support over here, acted as support over here. That's the weekly higher low. Now, I don't want to be too doom and gloom and saying like, okay, let's prepare for this major weekly pullback. I'm just pointing out this sort of possible threat underneath 654, excuse me. But what is the reality of the chart we're dealing with in front of us right here, right now? Should we be overly concerned about the 2-week equal low getting taken out? I personally don't think so, as long as price is spending more time over Thursday's high. The reason I say that is because this was, as we talked about on Wednesday, kind of just a range. It really was an expansion of range to the downside. The sellers really only achieved expansion of range on the pullback session from Thursday after the morning gap down. But that was promptly recovered, and you can see that we actually closed on Friday over this 660.40 spot. So as long as the market is over 660.40 early on in the week, to me, this higher low should persist, and we should probably seek some sort of equal high on the daily time scale, which is here at the all-time high, 667.25. And as we know and talked about on Wednesday, this is the improper end of the auction. You really should see an excess high, not back-to-back equal highs like this. So my first thought would be, if we come up and tag the all-time high, we should probably look for that level to be repaired via some sort of break through it. Then the question becomes, do we accept above, or do we promptly reject back down underneath after setting some sort of excess high over 667.25? That question can only be answered when and if the break actually takes place. But once again, on the daily time scale, the trend remains up. This is a firm higher low. It's over the daily 20 SMA. And on Friday, we actually reclaimed this 660.40 spot. So as long as we're over 660.40 on the daily time scale, I would be seeking an equal high. If we were to drop underneath 660.40, this is kind of a neutral zone. We'll see this on the hourly chart in a second. And then underneath 658.50 is really where I would start to say, okay, it's definitely possible that we should keep a very close eye on the 2-week equal low that we were just referencing that could unlock the possibility of a daily downtrend via a lower low underneath the lower edge of the weekly expected move. Next levels below, as you can see, are 650.225, 650.85, and then the major daily spot at 647.50. I don't want to get too aggressive to the downside, because the other thing we can do here is come in with a Fibonacci from this major low up to the high, and what you'll notice is that Thursday's low was a perfect hold of the Fib 38.2. So is this anything more than just daily bull flag consolidation from this perspective? Survey says no, this is bullish until proven otherwise, as long as we're over, well, ideally, the equal low down here at 654, but early in the week over 660.40 is just a perfect hold of that bull flag reference point. Let's clear this up and let's take a look at the hourly time scale. So we can clearly see that the hourly trend did flip to down here, highs, lower highs. You could even count this as a lower high. This could have been a lower high, lows, lower lows, lower lows. Absolutely an hourly downtrend. And what is already starting to take place into the close of Friday? You now have lows, and you have the possibility of higher lows trying to stay over this 658.50. The reason the level is 658.50 is it's the unchanged price from FOMC prior to the volatility. As long as we stay above that, right, it's really difficult to say that the hourly trend remains down. We now have lows, higher lows, right? You could pull back here and still set an equal low on the hourly chart coming in from what is now a higher high on the hourly chart, right? If you're counting sequence here, you have highs. Let's just go through it again. Lower highs, lower highs, lower highs. From here to here, you now absolutely have an hourly higher high. So the most ideal outcome is already in confluence with what we just described on the daily time scale. It's consolidation over 660.40. Brigade bolt over 662.25 navigates to the opening print of Wednesday. Then above that, we're targeting the all-time high. Notice how this is a fairly thin structure breakdown, and this is a fairly thin structure breakdown Monday. What goes straight up comes straight back down. We could easily see a move, because there's not much volume commitment at price there, over 664.50, that could be a snappy scalp straight up into the all-time high at 667.25. If this chart's going to get a little bit more tricky to navigate, what you'll start to see is a rotation underneath 660.40 and then what becomes the threat, right? Because the hourly trend is starting to flip back to up via higher low and higher high. If this is going to roll over, if the hourly trend flips back to down and we're making an equal low here, what is the major threat, right? Everybody can see this, or hopefully like we're putting the pieces of the puzzle together. This is now a lower high, and then it becomes all about 654. If 654 then breaks, sayonara, you're in a daily downtrend via the lower low after a lower high, and the weekly pullback will begin. You would also be violating the daily 20 SMA if you were to start breaking down underneath that 654, equal low here on the daily timescale, and on the hourly, the lowest low of the most recent pullback. Now, it's not all sort of lost. If we get this consolidation, let's just come in with the simplified pathing, right? This is very clean upside that we know we're looking for. If we get this, I would give the market the benefit of the doubt and also continue to try longs on any recovery back over 660.40, noting that you still have this opportunity for a higher low on the hourly chart. Where things really start to get more compelling to the downside is acceptance underneath, once again, the unaffected price from FOMC here at 658.50. Right? So if you get this and then this, okay, that's not so great. I would start thinking along the lines of that lower high we've just described, and then of course the equal low being the next target at 654. Okay, that's what we have to the downside. That's how I'll be navigating the trend here as we come into this upcoming week's worth of trade ahead of some of the key labor data. We'll update you on Wednesday with how this market shakes out. If we bring in a Fibonacci from the all-time high to the low of this pullback, notice that we have moved over the Fib 38.2, so the bears cannot claim bear flag consolidation. That would have ideally been down here. And as we can see, a move over Friday's high is a recapture of this 61.8 Fibonacci, which dramatically improves the odds of the 100% retracement. And think about how that aligns with the daily trend remaining in the upward direction, a great hold of the daily 20 SMA. The hourly trend flips back to up. If you're over this level, the hourly trend is continuing, and the odds once again would favor some sort of 100% retracement to the all-time high. So really interested in that possible outcome. You could see which way I'm leaning here. This would be ideal, some kind of bull flag, and then a Brigade bolt over Friday's high. The only thing I'll point out here is that Friday's initial reaction off of this level at 662.25 was slightly concerning to begin with, but the end of day grind back in the upward direction kind of keeps things okay. If the second hourly bar of the Friday session had actually spent more time underneath 658.50, I'm not sure I would be sitting here talking to you about a bullish continuation of this hourly trend reversal, and when I would have said something more along the lines of, yeah, this overshot, it technically made a bar-to-bar higher high, but if on Friday we were back in here, it really looks like a failed attempt to reclaim what would have been a very, very critical level once again. All of these prior equal lows at 660.40. Because of the afternoon session on Friday, I'm a little bit more optimistic about the grind back in the upward direction, continuing the daily trend in the upward direction. The final thing we'll throw on here is the intraday anchored VWAPs, and just showing you that if we take a look, let's make this a little bit easier on the eyes. There we go. We're actually above a majority of the stack here. We've closed right at the FOMC anchored VWAP, which is the purple or pink one on the screen here. But if we're above it, we're above the entirety of the stack, and then again, the target becomes the all-time high. I think that's a fairly straightforward trade over 662.25. If we're getting consolidation in here, this is where, once again, I would try to maintain a little bit more of a neutral stance, and I would be hard-pressed to change my tone to overly bearish until we actually break down underneath 658.50, which is confluence, at least early in the week on Monday, with the anchored VWAP from that Thursday pullback low. Right? If we're over this, then I would say it's not all hope is lost, and not all of, but a majority of the dip buyers who got involved on that Thursday session are still feeling happy about their decision, and they're still probably in green on that potential trade. So 658.50, 660.40, 662.25 are your critical levels early on in the week to be watching on Monday. We know how important 654 is. It shouldn't be the primary idea first, noting the reaction off of that level. The other thing we could just read into here, right, is look at the extreme response off of that level on both hourly lower wicks that started to get into the daily 20 on Thursday. Very powerful reaction. All of the value was higher on the Thursday session, and we did see value progress in the upward direction on Friday. So to get one layer deeper, let's take a look at the market internals. If you're not familiar with the internals, check out the video tutorial in the top right-hand corner. What do we see here specifically on Thursday's gap and go to the downside, and then Friday's follow-up session, right? So Thursday's gap and go. No substantial volume outflows, and we did see a strong volume inflow follow-up on Friday as we got that rebound back higher off of the daily higher low. That checks out as being bullish. Notice the advanced decline line gets close to trend lower zone on Thursday, but it rebounds in an equal and almost opposite fashion on Friday. Another bullish indication here. The other bullish indication that I'd really like to drive home is look at the intraday index score here into the close versus what was happening on Thursday. If we had stronger sellers continuously selling the market on Thursday, indicating an agenda to move the market lower substantially, you would have expected this to close fairly weak. It didn't happen. It was more so flat. Versus what we had on Friday, much more sustained buying pressure on the index level as we go into the close there relative to what we had the day prior from the gap down. Another bullish takeaway there. If we look at the cumulative build on Thursday, not as bad, especially considering it was a gap and go initially out of the gates, right? Not as bad as what we had on Wednesday. Signs of selling pressure easing. If we look at the Friday session cumulative build, much more two-sided trade, which I'm not going to say this is the strongest cumulative build. I simply can't do it. A much better follow-up would have been something like plus 5,000. However, one way to possibly view this is just two-sided trade, right? You don't want domination from like big swings to sell side, big swings to buy side, big swings to sell side. If you get that overly correlated market, it's going to be very difficult to actually build a trend, and you're just going to introduce volatility. So I'm not trying to skew the data points overly bullish, and I'm not trying to make something out of nothing, but because this has a pretty fair distribution over and under zero, it would actually indicate more of a rotational market where there was a fair bit of two-sided trade, and if we're seeing two-sided trade, which is lifting the market, that's more sustainable than just complete buy-side domination. Now, again, strong reactions, initial reactions, it would have been better. Don't try to sugarcoat what isn't there. It would have inherently been better to get a 5,000 positive build. Anyways, that's the internals dashboard. It does not look overly bearish. We talked about this on Wednesday. Even when we broke down on Tuesday and Wednesday, not even close to substantial volume outflows. Look at your index advanced decline line here. Just not indicative of new money sellers. So in my view, this is a pullback in the context of a daily uptrend. We have held a daily higher low, and in my view, unless we get some sort of data on Friday, which is the major labor report, I think we want to trust this uptrend that we're continuing to build out. Let's take a look over at the market profile for the ES, and what I want to point out is, once again, and by the way, if you're not familiar, check out the video tutorial, top right-hand corner, it's always there. If you could see this on Thursday, right, value moving higher instead of in that lower wick, if you see the great excess in J period here and the volume taper at the low of day, that's the proper end of the auction finally versus this lack of material excess. This is a poor low on what would have been Tuesday's session, right? So a very constructive look from a profile point of view. We do have a poor low on the Friday session, a little bit of an excess high in B period here, but look at where value lands on the session. It's completely clean, mostly clean. Maybe I should double check before I say completely. Mostly clean over the top end of that Thursday range here, which is absolutely bullish. This is progress from the buyers in the upward direction here. The next major watch, and it's obviously the same level. If I just do something like this, you can see it's Friday's high. The next watch is a break over Friday's high, which reclaims the single prints from the Wednesday breakdown. Remember, we had E period single prints here, which loosely, it's better in the NQ, but loosely align with the Tuesday low as well. If the ES can get up and over 67.06, that's the key level right here, Friday's high basically, then you're looking for that continuation, right? You just don't have sellers who are initiating in this lower distribution. You don't have anyone who's sold the bottom of the market here who's going to be feeling happy about that. Value and basically momentum is trying to continue back in the upward direction, given what we can see here from a value area perspective, that clean move in the upward direction. Let's get back on over to the platform on Thinkorswim and take a look through our good friend, the NASDAQ. Let's reset this. Thanks for bearing with me as always as we jump up to our weekly over on the Qs, and let's get the job done over here. So as we can see, very similar in terms of candle structure, a little bit more of a candle body on the QQQ weekly, but nothing that overly changes the analysis, right? It's still mostly unchanged. The upper wick here is technically a bar-to-bar higher high. You have much more of a higher low, but you did still close back down inside of the previous week's range. So indecisive structure, slightly more bullish location via the higher low rather than an equal low, but the close is still sort of that neutralizing data point that says, progress really wasn't sustained over the previous week's high. If we're thinking about the major trend, just like the S&P, this is the highest high of the trend count. There's really no issues with that. We know that this is a weekly balance range down here. So on the weekly chart, as long as we're over these prior highs, there's really no reason for concern over 580. Pullbacks or consolidation that persist above keep the buyers, really just think about this like building blocks, right? You're building out the next chunk of consolidation in the upward direction. If we come in here with the Fibonacci's from the bottom of the China deal to make a deal and gap up towards the new high, Fib 38.2 is not yet at the top end of the range, which would just mean this would be ideal consolidation. If we dip a toe into the range, not the end of the world, and just like the S&P 500, your 61.8 is now confluence with the prior all-time high from here. Let's just check in from the low of the tariff move up to the new all-time high. Fib 38.2 not quite catching up, but again, that is the idea over time that it will provide confluence at some point. Let's come in here with, instead of a new drawing, rather our anchored VWAPs on the QQQ weekly. Once again, notice the top end of the range is confluence. You're really batting 5 for 5 if you're over that 580. No issues here on the weekly time scale. If you were to see a move into that range, you're still over, at that point, 3 of the 5 anchored VWAPs. It still becomes very difficult for me to want to take a short stance in the NASDAQ as long as we're in this range. I would certainly be paying attention to the bottom end of this range. If you were to break down underneath something like 555s, that becomes compelling because now, right, let's say there's a lower high here. What did I just draw, right? All the pattern traders can rejoice. There it is. There's your head and shoulders under the neckline, probably sends it lower. And now we're talking about that much deeper pullback to at least prior all-time high, if not the origin of this breakout move from back here. So we'll deal with that when and if it becomes a threat. But let's just reorient ourselves to the chart in front of us right here, right now. Not the end of the world, still an uptrend, plenty of room for a higher low, small slowdown in trend momentum, but not a full-blown trend reversal by any stretch of the imagination here. Let's jump into the weekly volume profile, and let's just see what we have. This is just the all-time high. There's nothing to really read into there. If we take this one out, we could see it's the top end of the balance range. So all things considered, spot on with the analysis so far, the levels, the volume, it all aligns, as do the anchored VWAPs here. Let's come into the daily time scale of our good friend, the QQQ, and let's see what's going on from a expected move perspective. And then we'll, of course, talk trend structure, the whole 9 yards. So here is the expected move. Notice that we have a brand new all-time high in the upper bound. That's 606.63. And at the lower bound, we do technically have a lower low, which is not great at 585.30. I would still sit here and say that the daily trend is up in the NASDAQ. You have lows. This was a firm higher low, noting that the hourly trend did flip to down via a lower high here, and of course the lower low on FOMC. So I do like the fact that this is a firm higher low from here to here and a firm higher low from here to here. We're still well above the daily 20 SMA. There's certainly this nuance between the NASDAQ and the S&P where you did not close quite as strong back inside of that unchanged balance range up here. You're just below it on the NASDAQ. That would really be 598 and 596.30. We'll see that on the hourly chart in just a second here. So a little bit of nuance from that perspective, but the trend is still strong. It's still in the upward direction on the weekly time scale, right? That weekly balance we were just talking about is down here. We know that this is a double bottom on the daily. This is still triggered. You're all the way through to the measured move of that by now. So trend is up. Obviously here, multiple lower wicks on Thursday and Friday. Buyers stepping up on pullbacks, continuing to support the bid basically over that daily 20 SMA. It does not look inherently bearish to me, and I'm not overly concerned about a lower high threat yet. It would be early this week if the S&P fails that 660 spot we were just talking about and breaks below, as well as the NASDAQ remaining underneath this 598 rolling back over to this equal low, I would start to be a little bit more concerned here. Now, again, thinking about what we're shorting into if the daily trend reverses, if we get, let's just say, again, pattern traders rejoice, there's your little head and shoulders on the daily, here's the break of the neckline. What are we shorting into? There might be some thin structure to short through the lower wick of FOMC, but I really don't want to be a new money short as we're approaching the top end of that weekly balance, right? That to me doesn't make a whole lot of sense. So I would still remain somewhat cautious of downside if you're trying to navigate some sort of short position. And again, just taking a step back and reorienting to the chart, this is a fresh higher low over a daily 20 SMA. Let's not talk shorts before we have to, which would be, okay, lower high and back at the equal low and breaking down to navigate that range. For now, it should probably be, let's actually look long over 598, targeting the all-time high and then seeking continuation through what is unfinished business at the all-time high via the equal highs here at 602.65. If we come in with the Fibonacci on the daily time scale from this low up to this high, notice that all of this is taking place over a fib 38.2, so it really can't be bearish from a fib perspective. No issues from that view. Let's come into the hourly chart. We can all see the hourly downtrend. No issues with that. Highs, lower highs, lower highs, lower highs, lows, lower lows, lower lows. And of course, on Friday, you have some start of a higher high as well as some start of a higher low happening here. So I think it's very straightforward on the hourly chart, at least, that any consolidation here will keep the hourly trend trying to flip back to up. Brigade bolts over the top end of Friday's session are also a squeeze up and over the top end of this consolidation from the lower distribution on Wednesday. And we'll see this in the volume profile or the market profile in just a moment. So that's 596.30. A Brigade bolt above that, I'm still very cautious of this level here at 598. But hypothetically, right, if we wanted to stick to the hourly level system to a T, you would actually have a level here closer to 600 rather than 598. Now, I still like 598, and I'm going to stand by that based on all the interactions that we've seen back here. However, again, over 596.30 really starts to open the door, and I would look for pressure in the upward direction towards this level here. Now, what I think, and the reason why I'm leaving the chart the way it is rather than using that 600 is if we were to just get opening drive and acceptance over 598, I think it's less about this and more about the all-time high. Right? And the reason I'll show you why, just like the S&P, of course, is if we come in from a fib point of view, over that 598, you're well above the fib 61.8. You're also accepting back inside of Tuesday's range over the single prints, which we'll see on the market profile in just a second as well. So anything that's here really should put the pressure on back up towards the all-time high. And as we know, let's think back through the data points, the daily trend is up. This is a fresh attempt at a higher low, to the tick, almost right at the unaffected price before FOMC at 588.35. So all things considered, this chart has been very, very respectful on the downside. I know we didn't talk about it much on the S&P, but I will go over it here in the NASDAQ. So let me know down below in the comments if you're making it to this particular instruction point or just this general call out. We joke about it, but when your Uncle Joe calls up the brokerage account and says, hey, broker John, I'm Joe, you're John, liquidate the portfolio. This thing's going to crash. It's going to zero. I don't like the state of affairs right now. Just sell it all. If that's the case, the market's not going to hold up at these very nuanced prices, right? 588.35. Stronger sellers will just blow right through that. There's going to be overshoot. There's going to be panic. You're not going to see clean holds of support like this. And it's the same thing in the S&P 500 at the daily 20 SMA, being so precise to that moving average. Stronger sellers don't care. They don't give a hoot, so to speak, about the moving average. They're just liquidating the portfolio. And we're just not seeing that. So again, in the context of a weekly uptrend, in the context of a daily uptrend, in the context of an hourly trend that's flipping back to up via this higher low and via this higher high, I don't think we have evidence of stronger sellers here. And we can continue to walk through it. I just had the fibs on here. Let's come in with the anchored VWAPs intraday. You can see we're above the entirety of the stack. If we're over 598, that's the entirety of the stack. If we're in here, that's that neutral stance where I wouldn't want to change my tone to bearish. I would still be looking for an hourly higher low over 593.65. So consolidation here, Brigade bolt here, Brigade bolt here, upside, right? The only time I really change my tone to bearish might be for a scalp only underneath, let's say we get this, underneath 592.15 could look for the equal low, and then maybe we'll reconsider. Now, again, do I want to be a short here? Think about this. Do you want to be a new money short at 588.35? Probably not. Why? Because the daily 20 is going to be catching up. The anchored VWAP from the bottom of the last move, this higher low from back here, is going to be catching up. You're short into support. If you're not short here at 592.15, I definitely wouldn't want to be short here. And this is just a scalp, right? That is just a scalp. Now, it's a different story, on the other hand, if this catches up, right? We get this. The market maybe made an attempt. It failed. It did this. If we're here, and then into the end of the week, we're here, this is a far different story. The expected value of, let's just call this A, versus the expected value of point B, on the short side that is completely different, right? So point B is a far more interesting short, but it will require time to actually set up and more information to say something like, okay, we failed to move back over 598. This does look like a daily lower high through the equal low with a lower high on the hourly underneath. that's a more compelling short story, right? We're just not there yet. So it's worth talking about the configuration of where these trends change. But if we lean into the charts that are in front of us right here, right now, with the supporting evidence, it leans bullish in my view as of right now. Let's jump into our NASDAQ side of the market internals. Let's see what we have from this point of view. You could see that the volume flows were up, not as substantial as the S&P on Friday. You also got close to substantial outflows on Thursday as that gap and go to the downside was taking place. So a little bit more cautious of that. Is this anything we're shocked about? No, because what do we know here? We did not close back up and over the key inflection point like the S&P did. So not really all that surprising to see some relative weakness on the NASDAQ. You can see we're over-correlated on Thursday, and a little bit of bounce back here is better for two-sided trade on Friday. Same story with the cumulative build on the Friday session, at least on the Friday positive build. Thursday is a little bit more aggressive than what we have on the S&P. Remember, the S&P made a higher cumulative build relative to Wednesday. So if there's going to be weakness, it's the tech market is the more susceptible market just because of its concentration. If there's going to be more of a rotation out of that because the S&P is more diversified, I would think the impact is blunted in the S&P 500. Let's jump on over to our market profile for the NASDAQ, and what we'll see over here, very similar to the ES in terms of this, right around in here. Your single prints from the Wednesday session are the Tuesday low, and if you can reclaim that, if you can recapture that level, which is the equivalent of the 598 spot we were just talking in the QQQ, you're looking good. That's going to be around 24,775 in the NQ futures. Now, what you'll also see here is decent excess on the A period low from the Thursday session. B period has better excess than what we have on the S&P from Friday's session, but look at these highs. This has been repaired because we've traded through it on Friday, but look at Friday's high. That is an incredibly poor high with 4 TPOs back-to-back across the top. That's the improper end of the auction. And what does this sort of align with? If you do something that looks like this, it's a low volume void from back here. I'm not going to sit and say it's like perfectly through the single prints and E period there, but it is a general low volume void. If I do something that looks like this, notice how the volume starts to taper off in generally this segment right here versus where there's more value found here. So if we break through that, I would expect an attempt at that Tuesday low. I would expect an attempt at that 598 spot that we were just talking about in the QQQ as a reasonable scalp. If you accept above that, that's where I think it's much more bullish, and the market will try to make an advance towards the all-time high in the NASDAQ. Let's get back on over to Thinkorswim and see what we have with the last of the major three. We have the Rusty Russell, and let's just bump this up to a weekly time scale, and let's take a look at our candle structure and location. So again, doji-esque in terms of indecisive action on the weekly close here, a little bit more of a candle body and a little bit more of a larger upper wick. Actually, it's my drawing's slightly not to scale than what we had in the NASDAQ and the S&P. I'd say it looks more similar to the S&P than the NASDAQ. You did start to set more of an equal low. It's still technically a higher low. And again, that closes back inside of the previous week's range after setting a higher high, which is a brand new all-time high for small caps here. So is it possible that you could be a bit susceptible to a breakdown on the weekly underneath the multi-bar lows here? I think the answer is yes. As we're considering the major trend, again, not much of a change here. It's from the highest high. You can easily set a higher low on the IWM weekly time scale anywhere over about 226, the top end of this balance range from back here. We know that. If we come in with a Fibonacci from this low up to the major high, 61.8 is spot on the money with that level. If you come in from this low up to the new high, you would still be well above the Fib 38.2. Let's come in here with our anchored VWAPs on the IWM, and I finally remembered to update the anchor to this pullback day here, pullback week. We're well above that. So if we pull back, first reference might just be that anchored VWAP. Second reference might just be this for, once again, weekly higher lows to preserve the trend in the upward direction. Let's come in here with the volume profile on small caps, and let's just see what we're working with relative to these highs. As a matter of fact, this is the tricky one. You've always got it. We don't need 20 years, but maybe 5 will do. We want to look at this node from back here. So the high volume node is the multi-week low. If you look at where this bulge is right here on the volume profile, if we take that out, again, is it unreasonable that you might come into the top end of this high volume node? Absolutely not. So the weekly pullback, there's an argument to be made for it, but it's just not enough to actually change the trend overall of what small caps are doing here. Let's navigate down to the daily time scale, and let's see what we can see from this perspective. You'll notice a small discrepancy here as well in terms of the expected move. You could see that we have the all-time high, or the hourly level at the all-time high, being the upper edge of the weekly expected move. That's 246.24. That is not a higher high. It's not a new all-time high. And if we're contained by the lower bound, 236.44 does imply a break underneath the prior week's low. Now, what you'll also see here is that the multi-week low is just kind of like this zone here, here, here. If we start taking these levels out, then it probably becomes more reasonable that the market is looking for that larger pullback to the top end of this range, as noted around 226. I think let me be careful with my wording here. I was going to say easy trade. The easier short is through this thin structure underneath 232. We've talked about this concept in a couple of the midweek market update videos as well as the morning preps, but if you just think about how this structure has built out here, you have this grinding move to the upside where a lot of positions have been built. So there's more of a reason to think that the market may try to defend these areas or go sideways and consolidate in these areas rather than break down through thin structure and offer a, quote, easy retracement. And remember, everything exists on a spectrum in the market. You have easier, trading is hard, right? Trading is hard. You have easier and more difficult in terms of setups. Trying to short this through all of this grind, that falls over here, more difficult. Trying to short this through the thin structure, that is easier. And again, trading is not easy, but it falls on that side of the spectrum. Let's go ahead and take a look at the daily trend. It still remains kind of loosely in the upward direction. This is the all-time high, and we've pulled back from the all-time high. So kind of sitting here on an equal low is not the end of the world. I would want to see early in the week price acceptance over 241.50 if we're going to apply upward pressure or a tailwind to the S&P marketplace. I want to get back into this balance range here, build out higher value. This looks like a higher low, and then break for new all-time highs should the small caps revisit that level up there around 246. And again, that comes from a recapture of 241.50. If we're underneath and in here, I have to maintain a little bit more of a neutral stance being underneath this. Is it possible we have a lower high brewing? Possible, but I wouldn't be short totally until we're underneath 238.50. And even at that, as just described, it's a very difficult short into some of these areas of value. So let's take it on down to the hourly chart. You could see that maybe this is just a major double top, and as long as we're underneath the neckline, you might want to take a little bit more of a dialed back stance in terms of how bullish you are on small caps. That's fine. 241.50 is still that key level. If you can Brigade bolt above it, that's where I think you get some rock and roll action back up towards those highs as just mentioned. If you start to see a rotation that goes like this, now all of a sudden, right, you're talking about a daily lower high. Why? Because the hourly trend has flipped to up. You have lows, highs, higher highs, right? So if this hourly trend is flipped to up, this equal low is going to set a daily lower high, and then you're much closer to a full-blown trend reversal in the small caps, probably sooner than what you have in the S&P or the NASDAQ. Right? So that's one way to envision this. And I think it really just, let's keep it simple here for smalls. It's all about early week, what happens with 241.50, and then subsequently what happens on Friday with the full Monty labor report. You get hourly earnings, you get the NFP, as well as the unemployment rate. So that is the major watch on small caps. Two key levels, 241.50, 238.50. Let's come in here with the anchored view apps and the fibs just to be congruent. From high to low, you could see perfect alignment with the fib 38.2. So the bears actually can claim that yes, indeed, this is bear flag consolidation underneath the neckline of that double top, which is why, once again, 241.50 is such a big deal. If we come in here with the anchored view apps intraday, notice that we're underneath the FOMC anchored view app as well as the all-time high anchored view app. Thus, once again, 241.50 being reinforced. And if you're to crack all of this, you're underneath the entirety of the stack. That's where the door opens up for downside. Again, be cautious of that downside and just, how, quote, easy or difficult it may be, noting this chop and slop from the past. Let's get on over to the Russell side of the market internals and see what we have from this point of view. You're going to see much stronger volume inflows here on Friday versus what we had on the NASDAQ. The advanced decline line much more muted versus overcorrelated on the NASDAQ. Much more of a weak build on Thursday relative to Wednesday, and a better cumulative build to the upside on Friday versus the S&P 500. Let's go on over to our, I guess this is another thing to point out, this yellow box just reminded me. If you take a look at small caps, this was a gap, and technically we've closed the gap and we have not really moved above the gap fill yet. So it's still possible that bears are looking for a gap fill reversal so long as that 241.50 acts as resistance. I think it aligns with everything we've said already, but just another nuance in terms of the narrative and understanding what's going on with price structure as we're talking about the numbers. Let's go on over to the small caps market profile, RTY. What's going on with our futures over here? Taking a closer look. Zooming out a little bit, you have lack of material excess on the high of day. One thing I would continue to watch out for here is if we accept over Friday's high, that's going to put these shorts from the low of day on Wednesday under pressure. Remember that this point of control slammed straight into the low of day on market on close orders going through. If you start to see this get taken out over Friday's high, and again, recapturing that neckline of the double top that we just talked about on the hourly, I really think you have a recipe for a potential squeeze up there towards, really just back towards the all-time highs. If we go back on over to the chart here, you could see it, right? Through this, you start to put the pressure on, squeezing all these shorts, and you're navigating 243.25, 244.98. It's the prior all-time high, and then the true all-time high, 246. All right, so I think small caps can continue to be a bullish boon for the market so long as two things remain true. Number one, early in the week we get over 241.50, or number two, we do not break down underneath 238.50. We stay above, neutral through here, bullish pressure back on over the level. I think I've been pretty exhaustive in our analysis here on smalls. Let's get back on over to the S&P, the index everybody loves. Let's take a look through our sector performance, what's going on from a risk appetite perspective, and see what else is happening here. So, weekly performance, what do we see? Energy leads the pack here, up 5.18%, followed by utilities and then semiconductors. At the bottom end of the barrel, it's not down there, it's actually right here, materials, then we have staples, and you can see communications. One thing to point out is that energy, as we know, and utilities, as we know, are lightweight sectors. Utilities in particular are a little bit more D for defensive, but then semiconductors are much more risk on. At the bottom end of the barrel, materials are the lightest weight sector. Staples are a very lightweight sector, which is defensive as well. Then you have XLC, which is actually a little bit more risk on. So overall, I think it's a pretty mixed bag. And I think that this argument here that I'm trying to build is that the market's in a phase of rotation right now. You've seen a little bit of a cool off after these massive runs in the tech side of things, and now you're starting to get this rotational theme where some other sectors are catching a bid, energy, utilities, but you're not really seeing huge degradation in the risk-on sectors, right? And you can see this if you just check in on the structural charts. There's energy breaking out to close a gap overhead. Finally, how many months has it been inside of this range? Energy moving higher. It might be a subtle concern for inflation. If we go over to CL, we could start to take a look. It's moved higher, but I would say that this is not accepting over the top end of its range yet. It's really more range bound. And therefore, I don't think that the outperformance in the energy companies themselves is actually going to correlate to a big surge in inflation. If we take a look at utilities, upside, but the question I would pose here is, did this break to a new all-time high? And then more importantly, did it lead the S&P 500 to a new all-time high? Or is this outperformance taking place as the market's trying to set a higher low and everything else is actually cooling off? Certainly the latter, once again, supporting the rotation theme. If we look at semiconductors, hard to even say anything bearish about this chart. We've made the brand new all-time high, we pulled back mildly, and now we're really just building out a balance. And I'll continue to stand by this sort of thesis, even if semiconductors close this gap to the downside. Is this not a great opportunity for a higher low well above the breakout point from the top end of this balance range? Daily 20 SMA could provide confluence. It's still going to align with a daily uptrend here and, generally speaking, healthier risk appetite for equities. Now, of course, to get there, yeah, there's going to be an intraday short trade to take when and if SMH is moving through the gap. But once again, speaking thematically about the market, it does not strike me as a major threat to the uptrend and the risk-on sentiment as we've just noted. Let's take a look at real estate, no comment, still inside the range. If we take a look at industrials, no comment, still inside the range. If we look at financials, I do like the fact that it did not rotate all the way to the bottom end of the range, but I am still somewhat concerned over these multiple failures to move into blue sky territories here. I'm really keeping a keen eye on 5290. If we take that out after having failed the all-time high here, much more of a concern, noting this is the second heaviest weight sector by market cap for the S&P 500. So, doesn't look like it's in play early in the week, but 5290, please keep a close eye on that. You'll get much more of a headwind and probably a much more balanced S&P market if financials are breaking down here, as other charts such as the SMH are trying to set higher lows. XLK can also set a higher low here, even if it continues underneath this low, right? You're still talking about a weekly higher low here. Really no problems. You don't want to move the goalpost too much. You did have the hourly downtrend. That would solidify this as a daily higher low. In a picture perfect world, we're not any lower than 276.60. Otherwise, you start talking more about just an equilibrium forming, in which case, once again, you probably see slowdown in the S&P. Again, is this like, let's put the pieces of the puzzle together for just a second here on the XLK. What do we know about the weekly chart of the S&P, right? And this is a weekly check-in. Obviously, day to day, that's the whole point of the pre-market prep videos. We can trade the intraday action, but thematically, right? general sentiment-wise, grand picture of the market does not strike me as an issue, noting that the S&P can even set a weekly higher low should you consolidate here. And then let's just hypothetically say XLF does break down from its range, right? So just sort of trying to be prepared for multiple situations here. I don't see a road to ruin yet. I'm just not seeing it after this pullback here. It looks more constructive to me than anything else. If we look at the TLT, it's staying over this range here. It's my view that you probably see a low of the 10-year at 4%, and then we have to navigate to 4.2. 4.2, and its result there is probably dependent on what happens with labor this week. Let's go to materials. Starting to break down here from this range. That's a small concern, just noting that it did make a new swing low, obviously, below the level. So if it can reclaim that, that would be fine. It's the lightest weight sector. I'm not going to put too much emphasis on it. I think this is more of a compelling story. It's the XLP multi-month balance range breakdown after a failure to go higher here. If this is going to indicate some weakening of the consumer, maybe down the line we start to see things really deteriorate for the market, or we can even start having the conversation around the recession theme. However, what do we know has been driving the gain in the market right now? It really boils down to basically the infinite money glitch between, OpenAI invests in NVIDIA and NVIDIA partners with, Oracle or whatever. And it's just like money just keeps passing in between all these major companies, and Meta invests in the infrastructure, as does Amazon and Microsoft. And they're all just, playing with the same pot of money. I don't think you're going to see the market collapse so long as this AI story and all the money just keeps changing hands from company to company to company. It's like the state of the consumer doesn't really matter as long as that game can continue to get played. Now, if that game ends, then this spells trouble, right? So I am making note of just the massive bifurcation between like staples versus sort of tech, so to speak. Let's jump into communications, and therefore that's like sort of a threat when it comes to narrow market breadth, but not enough to just short the market. If we come into the XLC, this looks great. You broke from the balance range, closed back in on Friday. I mean, all-time high really lacks material excess, so I would be thinking about that getting some repair up there at 119.25. An excess high would be much better. If we're thinking about, Thinking about XLV for healthcare, closed the gap to the downside, tried to rebound on Friday. I would just be minding the overhead supply. If this continues to rotate, I think it falls into the same category as the XLP. I don't think the market's going to care all that much because of the whole AI story and all that money changing hands we just sort of walked through, but it is something to pay attention to when and if the sort of party stops over in the AI and tech spend world. Then maybe this becomes more of a dominating factor in the possibility of a larger breakdown in the market, but I'm just not seeing it yet. If we take a look at discretionary, mild pullback here well above this previous level. Oops, there we go, 234 if we zoom back out, this prior shelf, right? So nice mild pullback, higher low, looks pretty darn good. Closing back inside of this balance range on Friday, no issues, still strikes me as being bullish here. We've already talked SPY, so let's jump into our ratio grid. If you're not familiar with how to configure ratios on Thinkorswim, it's a great tool. Check out the video tutorial in the top right-hand corner. So what do we see here? Risk on, risk on, risk on. This continues to be our threat, but we know that based on the underlying structural chart of financials anyways. We do not have risk off, we do not have risk off, and we do not have risk off yet, although utilities are starting to attempt a trend reversal. We don't have a full-blown trend reversal, but it is something to keep an eye on. If we take a look at the AB set, what do we see on A? Checking all of the bullish boxes. We are literally 6 for 6 in nice strong uptrends here. That is risk on. If we take a look through the B set, you can see gold continues to outperform here. You can see that bonds continue to underperform. So that's a little bit of an intention data point. And if you look at Bitcoin, Bitcoin actually broke down pretty aggressively. Anyone who is following along, I did end up stopping out of what was an initiative swing trade. It was a long looking back towards this high on the breakout of this flag. Anyways, that has been stopped out. For now, though, just reevaluating and saying, okay, does Bitcoin hold this equal low? And if not, all right, maybe this starts to become a headwind, and we can't say we're checking all of the bullish boxes, but we're still checking a majority of the bullish boxes for the base case remaining in the upward direction. Let's come into our dollar and interest rates just to illustrate here that as the dollar moves higher, right, we've seen the 10-year come into that 4.2 retest level, and I think it's time for the market to make a decision, especially with the labor data we'll be getting this week. Do rates need to move lower? Because, of course, if we get weakening of labor data, I would expect lower rates. And then the dollar weakens, and then dollar-denominated assets probably go up, right? You're probably talking about gold continuing its trend into newer highs and maybe a recovery effort in Bitcoin. So I think that story is worth paying attention to for a trade into the upcoming week here. Let's jump into the inverted ZT, which will just show us that, of course, the market is what should I say? Unpricing, I should say, some of the elevated odds of the dual rate cut into the end of the year. I think that this is going to be wildly subject to change on the labor data that we will get this upcoming Friday, really throughout the week. So speaking of, let's just jump over to the Fed Watch tool here. You could see, and if you recall, right, this was over 90% odds not that long ago. Now, I get it. It's still 87. The market's still pricing in high odds of a cut there, but even these odds have deteriorated to some degree. You could also see that this is now a much more flat print here instead of really coming in more aggressively, getting something here, and then building back out slowly over the span of 27. Now, obviously, we're forecasting way into the future here. However, the main thing to watch for is how these numbers change on the release of labor-related data early this week. So a lot of Fed speak will continue to pepper the headlines. However, JOLTS is your first major taste of labor information. That's 10 o'clock on Tuesday. Please be aware of that. And then you can see here Wednesday, 8:15, non-farm payroll from the ADP side of the house. This will give us a directional vector as to what we should expect for the Friday session. I'll also point out the 10 o'clock time frame, ISM manufacturing PMI. I don't think the market cares as much about the manufacturing side as it does the services side, but as you'll see, that's Friday. Thursday, 8:30 jobless claims, nothing out of the ordinary there, the usual stuff. And then you can see Friday is the full day of fireworks with the full labor report happening at 8:30. We'll have coffee and donuts up in the penthouse office for the pre-market prep. And then here it is, the sneaky one, the ISM Services PMI. You want to continue to pay attention to prices paid on ISM Services PMI. We know that it actually had a downtick last month. That would indicate the one-time shock to the price level, as Jerome Powell says, was short-lived. It's short-lived, and perhaps we're not going to see inflation become a persistent issue. So I'm really paying attention to prices paid from ISM services. That's Friday at 10 o'clock. We'll, of course, remind you of that on Wednesday's midweek market update video, as well as through the week in the pre-market preps. Let's jump into the earnings calendar here. It's really just Nike after the close on Tuesday that anybody should even think twice about. Nothing else really worth paying attention to here. And then we know that financials will kick things off in mid-ish October. So we'll get a little bit of a reprieve before the next major wave of earnings. Let's get back on over to the platform here. Let's finish up today's analysis with the supporting evidence categories. Where are we? We want the bond relationships. I still am trying to figure out what we want to pay attention to next here. If the short end starts moving aggressively higher, then the market maybe is more concerned about the neutral rate being higher than anticipated, which could be bearish. So if this flips into a major uptrend, we'll make note of that. But for now, it's still in this drifting downtrend over here. Market still seems somewhat concerned about the labor situation. Let's jump into credit spreads, which did roll over to end the week on the little multi-day, recovery rally there. So this aligns with the bull thesis still being alive. If we take a look at junk bonds, they really didn't do anything that's overly divergent. If we just swap out SPX down here, you could see we still have this look for a lower high, but as does the S&P. So really no concerns when it comes to that. You still have a very clear opportunity from here to here, high or low. You're not really divergent in any major sense. Let's come in here to, we already talked Bitcoin, but breadth. I like the fact that this was a very short stay, a single day underneath the 50% mark on the 50 SMA chart. Same thing here with new highs versus lows. And if we take a look at the RSP, you can actually see this as well. A little bit of an overshoot to the bottom end of the range on Thursday, but then actually closing squarely back in the midpoint on Friday. I would love to see breadth not deteriorate. And if we think about why, remember our conversation through the sectors. We saw consumer staples falling off of a cliff. We saw materials starting to break down. We saw that the healthcare sector was starting to break down. If those things can put a pause on the bleeding, and you could stay inside of this range here on the equal weight S&P, any sort of break would improve, it would broaden the nature of the market rally outside of tech into possibly other instruments, other sectors. So watching that very closely, RSP could be an easy proxy for that. If you look at the QQQE, this actually looks fantastic, right? Here's this range down here. Yes, you broke from this, but notice that the higher low is well over these prior highs as you continue to support a higher low in the NASDAQ regular, like the normal weighted NASDAQ. Let's jump into volatility here. Volatility collapsing on Friday. That, of course, would just be indicative of totally normal, healthy, to be expected pullback in the context of an uptrend. No underlying issues there. The VVIX did the same, volatility of volatility. If we jump into our vol futures, strong contangos across the board. Same thing here in the 9 versus 30, and even on the one-day VIX, right in the comfort zone in between 1275 and 745. No major red flags, right? As this breakdown took place into Thursday, you didn't even break out through the high, right? So To me, it's very difficult to look at this market pullback as anything other than a healthy pullback in the context, once again, of a major daily uptrend, a major weekly uptrend, and we want to try to navigate that uptrend to a new higher high, unless a volatility catalyst such as labor on Friday derails things. And we know where that thesis is invalidated. It's really just underneath the equal low on the daily time frame chart of the S&P 500, which, as we just talked about, is that very easy watch here at 654. So that is the thesis through the broad market. Let's take a look through some of the core list of companies. Then I've got 3 trade ideas for you, and you're on your way. NVIDIA is absolute garbage. I would not touch this with a 90-foot pole is the joke. Don't ask me how you carry around a 90-foot pole. There's 2 ranges. It's the major range and it's the minor range. You saw the Oracle deal and just like the OpenAI deal and just no follow through into blue sky territories. You saw the market consolidate straight back down into this range, tangled at the moving averages. Yes, you have daily higher lows. Maybe it's an ascending triangle at the all-time high, but you have to get there first. If you take a look at the hourly chart, I want nothing to do with NVIDIA inside of this box. Show me the move over 179.75. Great. All-time highs come into play. If you're in here, again, don't think about it. If you're in here, you could start to look for a small thin structure retracement, but I'd be cautious being short, right? Initiating a new short at this low. Beyond that, I would really have to see how the structure develops to determine whether or not, does it look like this is heavy overhead supply? How's the breakdown here? What does this look like? Maybe there's something to it, but I would really try to get the resolution of this box first on NVIDIA before making a major call in this name. If we jump on over to Softy, I mean, we can go to the daily chart. It's going to look ugly. A lot of these Mag 7 names actually have not been great traders recently. Look at these 2 boxes. If you've been trying to trade Microsoft, very, very tough inside of these ranges here. So this is on ice. This is literally closed right in the midpoint of the range on Friday. It's got to be over 518.50 to reclaim this previous level there, or it's got to be underneath the bottom end of the range to maybe break down. But do we want to short it into this? Same concept as the IWM. That looks like a much more difficult trade to take rather than a clean, thin structure retracement. So on the hourly chart, the only thing I'll just share is that if it does break down, I think there's a scalp only for a quick, thin structure. You have wick. There's really not much until you get to 503. That's under 506.50. So 3.5 points to trade for in there. That's kind of the only short side trade I would look for. If you look at Apple, you got a great daily bull flag up here. Look at this high and tight consolidation after the iPhone 17 rally. Little inverted hammer on Friday session for sure, but over something like 257, I think it's asking for the all-time high at 260.10. If you take a look at the hourly chart, it's really not all that bad in terms of the hourly structure on Friday. It's more so consolidation than anything. I wouldn't read into that daily upper wick as being overly substantial. I just think you need to play the patience game, right? Which is over 257, making sure there's a setup there and then trading the all-time high. If you're just in here, don't front run it. It just doesn't make sense, right? I wouldn't really be short Apple until you have a clean lower high underneath something like 251.35 to close the gap down here to 246. Next up, we have Amazon. Amazon's finally getting in gear and finally starting to clarify the daily timescale. If you look at this, it's a multi-pronged approach here. You had a weekly breakout level through this high. It failed. We knew that. This lower high now looks clear in hindsight. However, the major breakdown is this level, right? And there's actually a couple of really nice Amazon shorts into the end of the week here underneath 220.50. Looking at the current, daily configuration, upper wick there, rejecting this spot, in my view, continues to keep this short alive. And I will continue to look on the short side for Amazon to sort of reject underneath this zone, targeting the equal low, and then really trying to navigate the daily 200. It's the green moving average is slammed into the bottom of the screen. There you go. You can see it a little bit better now. So that would be at 215.40. If Amazon's going to get in gear to the upside, you're really going to need to see some kind of Brigade Bolt Stevie Wonder up and over 221.15, targeting the equal high here, and then the daily 50 SMA. If you're just kind of like, if you're just in here, it's short. I wouldn't really think long about it. If you're in here, you could try this counter trend. I would just be a little cautious of it and don't overstay your welcome. I guess the main moral of the story is if this is inverted head and shoulders or something of the sorts, scalp only. Don't overstay the welcome on the long side at the equal high here. I think you could have a recipe for disaster. The only time this would become more compelling is if it does build out some sort of new structure here and then do this for another thin structure retracement through the major breakdown here into 227.60. That's Amazon. Next up, Google. Let's take a look at the daily chart. So great hold of the daily 20 SMA, a little bit lackluster follow through, so to speak, on Friday. There's the overnight news headed into Friday about the deal with Meta to improve ad targeting. It didn't really follow through into this consolidation from back over here. So you're between a rock and a hard place. If you were to think about like what the daily 2-day conglomerate bar would look like, it's kind of just an indecisive doji. I would really just be watching on the hourly chart. You could see this very clearly. I would just be watching for consolidation in here to remain bullish, generally looking for this as the next long over the high of day from Friday. That would be at 249.60 to 253 being the next target. If you're going to short this, I would probably maybe a scalp underneath 244.40 into 242. I wouldn't overstay your welcome into the daily 20, noting the first reaction here. And generally, that Google has been one of the Mag 7 names that has been on a much cleaner trend in the upward direction than anything else, right? We just looked at Amazon, we looked at Microsoft, NVIDIA. These names aren't really trending cleanly. Speaking of things that aren't trending cleanly, here's another one, Meta. Looks absolutely horrific. Shouldn't say I hate the chart. I'm open-minded to something developing on it, but what are we going to do with this? I just don't really see it as a lucrative opportunity right now. There was one opportunity early on Monday underneath this 768 spot there. Sorry, Tuesday. But that was about it. After that, there's really been not much going on here with Meta. Sideways. I think the watch could just be if this is going to go inverted head and shoulders and re-clear the moving average stack. Maybe you have that. That would be up and over something like 754.85. Not overly compelled for that. Even when we get here, you're talking about a major head and shoulders, right? And then that sort of puts in your lower high. Maybe. Bear flag here keeps the pressure on. Are we short into this? I don't really love that. Underneath 734, it might open up a little bit more so into the top of the gap at 722. You're shorting the very bottom of this move. I just don't love the Meta chart here. The Mag 7's been this way recently. You sort of have to be very selective with what you're trading here. Much better are the new kids on the block, which we'll get into momentarily. Tesla looks good, recovering back over this 429 level to end the week. And as we take a look here, consolidation will keep things bullish, and then Brigade bolts up and over 444.50 should likely target that 466.25. If you get back below 429, I think this is a reasonable short now. You've attempted once, twice. This will now be the third time, failing to go higher over the major breakout point from back here, the acceleration from this day. If you're underneath that origin, you could probably look short under 422.50. It's now a multi-day low from both Thursday and Friday. If you're below it, you've got some scalps going on to the downside. It's nothing major. It's not like the next blow-off top trade on Tesla that we're looking for here, but it's something to do maybe if we need some setups without forcing something, right, underneath a reasonable enough reference point. Let's jump on over to JP Morgan. They have earnings just right around the corner, again, early in October there, October 14th. Bull flag trying to break out on Friday. A little bit of a failure to move into those blue skies. I would say just consolidation will persist as being bullish. You still have this flag in play. If you do get new highs, just blue sky territories, $1.50, any intraday levels that form. If you do pull back deeper, looking for your daily 20 to catch it for a higher low. Not so much interested in trading this, but monitoring it for that XLF sector. If we jump into Palantir, I love Palantir's long lower wick. I love the failure of the gap down on Thursday. It's leaving me slightly optimistic for this break over time into the all-time high here. It reminds me very, very much so, if we just go to the hourly chart, it reminds me of this balance from back here, right? You looked underneath in a lower wick. You looked underneath via a gap down, long lower wick here. Multiple attempts from sellers to try to get price action underneath the major inflection point, which is the opening print from this gap and go day here. And it's very similar, right? You have sellers trying to gap and go to the downside, trying to get the breakdown here, and it's just not happening. So at some point in time, right, when you go through the top end of the range, when and if we take out this 183.75, I would think we want to be prepared for the 189 target on the breakout to the upside. If it is going to be downside, I would watch this 174.30. It's now a multi-day low. You have low here from, was that Thursday? It was. Thursday low and close to opening print. Friday close to the low. I'd want to be underneath that and the consolidation from this Thursday session now 2 weeks ago to initiate a potential short scalp into 170-125 through thin structure, but then here actually trying to flip back long, noting that that is your daily Brigade bolt. If we just go here, there's your breakout level. It's the origin of this breakdown as well. Let's just extend. This is your daily Brigade bolt here. You do not want to be short into that, especially if the daily 20 is picking up to offer confluence, 170-125. Next up, Broadcom. Let's take a look at this one. I'm a little interested in the failure to go lower twice now. into the gap once here and then once on that Friday session. So as of right now, probably thinking about on Broadcom the higher low Brigade Bolt squeeze up and over this flat high from Wednesday. That's over 339.60, probably puts the pressure on to some of these intraday levels here, and then your full target would be up at the prior all-time high test. We just zoom back out, it's the top of the gap up range. There we go. For the upside. So slow grind higher if you can break out over 339.60. Little cautious of this. It's not really the best intraday trader, and it would help if there was a catalyst, of course. Let's move along to AMD. This one belongs on ice. Let's start with the daily chart first. Nothing to do here until you're over 163.65 with respect to the daily 50 SMA. A nice beat down there on Wednesday morning. And then there's nothing to do on the short side until you're underneath 155.40 based on intraday consolidation from that rally session as well as the low of Thursday. So in here, don't get chopped up. Don't get caught up just trading where there's really no major edge. If you get this, thin structure retracement. If you get this, thin structure retracement. See how that works? I want to be playing where there's, quote, easier, remembering that spectrum that we were talking about. I want the easier trades, not the more difficult trades where I have to be on, Johnny on the spot, nailing the entry, nailing the exit. I want the trades that have more room to run. So those are the two zones, 163.65, 155.40. Here it is on the hourly chart. Really not much of a change in the analysis other than just pointing out once again, please respect the daily 50 if we start to see a move in the upward direction. If you see the downward move, right, this is that thin structure that we're aiming at here, which is why it's reasonable in my view. Let's come into Robinhood to finish the session here, and then we've got 3 additional ideas. Robinhood's got a little inside bar here, just unchanged, 2-day balance on Friday. Not a perfect inside bar. You technically have a slightly lower low. But this chart to me is trying to find a higher low on the daily, right? You have lows, higher lows, potential higher lows here, trying to hold up near, not perfect, but near the previous pivot. So I don't love this as a chart to have major ideas unfold from, but just out of the 2-day balance range, you have this. Mind the sort of breakdown point at 126.75. Under the 2-day balance, you could look for the gap close, gap fill reversal would keep me bullish. So I wouldn't be short under the 2-day low. I would only really be short. Where would I be short? Not even, I hate into the daily 20 as well. I really don't like the short side here on Robinhood. I don't know. I don't know if I would be short. You could also do this. Previous major highs are right in that zone. I don't love Robinhood on the downside here at all. I think that the daily trend trying to remain constructive and up is the major call until structure shifts in a major way. Like if we build out, something that looks like this, then yeah, obviously, right, we'll be working with that over time. But as of right now, present configuration of the chart probably says to go with until proven otherwise. Let's get into these additional ideas. Let's maybe start with MSTR for the sake of remaining broker/crypto-ish oriented. So from Robinhood to strategy, which is no longer micro, you've got this gap and go on Thursday when Bitcoin was breaking down pretty aggressively, right? That was that day where the economic data came in really, really strong. You had durable goods, you had GDP revisions in the upward direction, you had jobless claims really, really strong as well, as in coming in underneath expectations. So Bitcoin, and really you saw this with the dollar as well as rates, right? This stuff came in. And now that you have this gap and go, you have a little inside bar on Friday. If this is going to set a lower high underneath this major shelf of support, how could we not start to be a little bit more compelled for downside trades? So that's kind of what I'm watching here on strategy from a daily perspective. I don't know that the hourly configuration is beautiful yet, but some kind of potential move underneath 298 could open the door for further downside, 278.50s. If this is going to rally and close the gap, I would also keep an open mind to lower high opportunities, short opportunities, any trade setups that form intraday around this 317, 320, 323 zone. Okay, so 320 is the technical level from here. The gap is from 323 to 317. So that's the top watch or just additional watch out of strategy and how I would look to navigate this chart. Next up, we have, let's go semiconductors. Let's go MRVL. And then I've got something completely unrelated for the last trade idea. Although if you've been in the group, we already have sort of an interesting idea here. Marvel. What do we have with Marvel? Look at this little inside candle, 3-bar play, bullish 3-bar play on the daily. It's one of the stronger looking semiconductors, not overall, but in terms of relative strength recently. It's playing the catch-up game here. So I like the little inside candle. If we take out this high, it's also taking out this high. You're over 84.50 targeting. Look left. There's really just volatility to retrace back here from the tariff breakdown zone, right? That's really looking at 91.85 as the next hourly level as a major target. So on the hourly chart, you can kind of just see this as bull flag, Brigade Bolt over the level, and you've got, I don't want to say free and clear, but there's some room to run here, right? So definitely don't let your guard down. It's not like it's a free money trade, but I'd be interested in this move over 84.50. Very interested in that out of Marvel early on in this coming week. Let's go ahead and take a look at, let's jump into the final idea, which is unrelated, Lemonade. Lemonade is a stock that we've been stalking for a very, very, very long time. So long that we have our IPO opening print mapped out from back here. We've finally recaptured it after a massive stage 1 base break. Brigade bolt above, you could actually go like this. Notice this, right? Perfect. Now the next phase is, do we hold up over the IPO opening print? Not the most compelling weekly bar, I must admit. That is looking a little bit more like a bearish engulfer. However, if we go back down to a more comfortable time frame like the daily, look at what we have here. As long as this does not turn into a double top, as long as we hold 50, which is the place where it should hold, hypothetically, if this IPO is going to base out and continue higher, look at the back-to-back hammers, Thursday and Friday, daily 50, right off the level. If this is over the highs from Thursday and Friday, let's just jump back into this hourly chart. You could say your line in the sand might be something like 53.10. Over 53.10, you could probably start looking for a retracement higher for something along these lines, back up to the equal high. Whether or not you want to take this as a short-term trade or a longer time frame idea, totally your call, but interested in Lemonade here. Dual hammers, back-to-back, daily 50, IPO opening print. It's got a lot going for it at 50 in my view. And as a full disclaimer, I do hold a long position in Lemonade in my long-term accounts ever since it recaptured the IPO opening print. So I'm bullish generally on the stock, thinking about it sort of thematically and as well as technically, but I do think there's even a trade opportunity here as well, noting sort of the environment and location in which it's trading. So that is Lemonade, final idea from today's weekly watch list. That's all I've got for you. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Remember that we're live every single morning at 8 o'clock Eastern time here on YouTube for another episode of the Pre-Market Prep, where we'll send you on your way with a beautiful and lovely tailored game plan for that day's session. We'll be watching all of the economic data drops here together that are at least released pre-market. We're talking ADP non-farm at 8:15, and then on Friday, the full Monty labor report at 8:30, including average hourly earnings, unemployment rate, as well as the NFP non-farm payrolls. With that being said, I hope you have a fantastic and green trading week. If you want to join us, you know where all those links are down below in the description, and as always, I will see you in the next one.